set. Okay. Well, good morning, everyone, and welcome to the finale of our 2021 virtual spring conference. And we have a really great program for you today. Um, I'm pleased to report that we've had a great virtual conference over the past 2 weeks. The information and best practices we shared have been invaluable for me, and I hope that everyone has also found this time very well spent. For those of you who may not know me, I am your 2021 CORFAC International President, Joe Latina of Patterson Woods Commercial Properties, CORFAC International in Wilmington, Delaware. So before we get started and jump into the session, I would like to thank once again our sponsor and industry partner, CoStar. Joe Terrell, right, Joe? Right? From CoStar is joining us this morning. So I'm going to pass it over to Joe for a few minutes. Joe, if you can say a few words.
Thank you, Joe. I appreciate that. I thank you guys for giving us this time. We know with COVID, the great part about technology is offering the opportunity for all of us to see each other, see faces. I trust everyone's healthy, and really appreciate this opportunity for you guys, for us to be able to engage each other and grow. One thing I want to say is thank you to CORFAC. This is great to be able to have the time spent for this, and the leaders, the speakers. And I know that Anita's got some really good content for you guys. This is a great topic. It's a relevant topic for everybody. And so when you're going through this idea of emerging trends in the commercial real estate market, our commercial real estate is so dynamic, and there's so many different pieces to this puzzle, that all these different drivers, questions around population growth, or whether you start going to the suburb versus urban, and really, is our stores, do they still matter today? Or even safety and wellness now. So there's a lot of different drivers shifting and pushing the markets. With that said, there's a lot of you guys are CoStar subscribers. You're familiar with CoStar. You're familiar. We have 6 million properties that we track independently at the census level. Then we have 12,500 markets and submarkets that we're doing KPIs and analytical detailed data. Something that's very new that I think is going to help you guys be relevant for these emerging trends is we have just added over 1 trillion outstanding debt information through the CMBS data. We've just added all of that into the system. So for those of you who do have it, you'll have over 100,000 active loans, CMBS loans, that you guys can pull up offering or operating expenses, and be able to see income statements and financials that are live through the CMBS portal and CoStar. Be able to pull up a watch list. So as you look at trends in different markets right now, you'll be able to pull up the watch list and see who's going into default, what the balloon payments are, what's the time, what's the all these different details. So leverage the data. So right now, as you go through this, I want you to be thinking about that, leverage that data and how you can maximize your returns and ultimately just achieve the goals that you have. So thank you guys for the time. CoStar, LoopNet, 10X, and our exchanges are available. If you guys ever have questions, don't hesitate to reach out. I'm the VP of Sales for the Southwest region, Joe Terrell. Thank you guys very much, and we look forward to hearing Anita. Joe, back to you.
Awesome, Joe. Hey, Joe, I have one quick question. So all the new CMBS information that CoStar has provided, is that just included in our normal subscriptions?
Yes, sir. So we just added that. It's very recent and new. We've got 2 tranches of that data that's coming in, but it's going to be really important that you reach out to your rep, as you'll want to be able to find the best uses of finding distressed assets as you're looking through these trends in the different markets. So yeah, it's very, very new. So we look forward to kind of speaking with all of you guys, no cost.
Great stuff. Thanks, Joe. I appreciate it.
You're welcome.
All right. Without further ado, I have the absolute pleasure in welcoming this morning's closing keynote speaker, Anita Kramer. Anita is the Senior Vice President of the Urban Land Institute Center for Capital Markets and Real Estate. She joined ULI as a Senior Director of Retail and Mixed Use Development, directing research, education, and programming in that area. She was also responsible for the annual Dollars and Cents of Shopping Centers report, the Retail Development Handbook, and co-produced ULI's annual Reinventing Retail Conference. Prior to joining ULI, Anita consulted with private and public clients, performing economic and financial analysis on development and land use strategies. She holds a master's in city and regional planning from Harvard University, where she specialized in housing and community development. Please share any questions you may have in the chat, and we will address them periodically throughout the presentation. Now, please join me in welcoming Anita Kramer. Anita?
Thank you. I'm just setting up my system here. Okay. So thank you very much, Joe. I am thrilled to be joining today. So good morning to, I think it's good morning, good afternoon, good evening to the broad audience. So before we jump in, today's presentation, I just wanted to introduce Urban Land Institute a bit, just a few seconds on it for some context of why we even do the report that's the subject of today's program. So you can, so first of all, our mission is aspirational, as missions tend to be. So it's to shape the future of the built environment for transformative impact on communities worldwide. So you can see here that we are an interdisciplinary organization, with the core being developers and then all the related essential food groups. To achieve our mission, we focus on three things. So connecting across disciplines, inspiring best practices through convening content, education, and knowledge sharing, and leading in solving community and real estate challenges. So that's ULI in a nutshell. So now on to Emerging Trends. So welcome to Emerging Trends in Real Estate 2021. To say the least, this was quite the year for pulling together the Emerging Trends report. Unlike anything in its 42-year history, it wasn't unprecedented that a dramatic event impacted the process. There was certainly 9/11 and September 08, and we had an earlier timeline then. So both times we had just literally finished the report, and then everything changed. So this cycle was different. The pandemic has been influencing the market for a while now, but even though we've been living with it for a while, it's created an unprecedented, very fluid situation. So the one thing we do know is that we are still facing a significant number of uncertainties. So our theme this year is dealing with certain uncertainties. There are two major buckets, we believe there are two major buckets of many of the uncertainties. So there's the extent and the longevity of various potential changes. But as one institutional investor said, there are a bunch of things that will change at the margin, and changes at the margin can have huge impacts on the use of real estate. So before I go to the findings, I just want to tell you a little bit about the report. It's what I call the fine print. So it's the report, the work on it is jointly sponsored by PWC and ULI, this PricewaterhouseCoopers. It looks at emerging trends that impact the real estate industry broadly. It is annual, as I mentioned, this was the 42nd report. It relies, most critically, it relies on three types of primary research. So we draw from one-on-one interviews, of which there were 660 this year. We go to our local chapters that we call district councils, and they hold focus groups from their market experts. So we had 690 people across the country participating in those. And then we have an online extensive, and as one respondent told me, grueling survey, But despite that, we had almost 1,700 responses. So who is it that we interview and survey and have in our focus groups? It's really a wide array of senior real estate professionals from all food groups. So today's presentation is a lengthy report. I hope that today's presentation will give you a taste of the report, which I think will be available from CORFAC afterwards. So one of the most interesting survey questions is about expected profitability for the following year. So we do our work just towards the end of the previous year. And so this year we asked about the following year, the 2021. So this provides insight into what the market is thinking. And very importantly, it's because we ask it every year, it gives us a measure of change over time. So now, before we look at the survey results, I want to ask you the same question. So the question is going to be, how would you characterize the expected profitability of your real estate business in 2021? We have a poll on this. The poll's going to come. There's four answers. You see? And hopefully everybody, no matter what your position in the industry, please answer. I think you can start.
A or B?
So Diana, I don't see it. So you might have to report to me what the answers are.
Okay, I'll end it. Would you like me to end it? Looks like everybody's done voting.
Okay.
Can everybody else see?
Oh, there.
There
Okay,
it is.
got it. Okay, just gonna write really quickly. So everybody can see the answers. I'm gonna get back to them in a minute. I'll address them in a minute. Okay. Okay, so let's first take a look at the national results on this. So what happened to when we took it at the national level? Let's look at the good and the fair. So you can see that people were pretty much taking comfort in the middle. So that's about, and as everyone was trying to figure out what the long-term impact would be. So that's around 80% in the good and the good, fair to good range. And then on the edges, there were just small numbers on the edges, about the same, although this is the first time since 2012, I think, that abysmal was higher than excellent, but really both were on the margin. So pretty much we were in the good to fair. So let's look at, and I think that was the prevalent perception because it was taking time for people to figure out what the next normal is. So your response, interesting. So you as a group are also, I would say about 80% in good to fair, but clearly skewed highly to good. And great news is that there is hardly any abysmal and really 18% excellent. So this is, I think, a great indicator as to given the time lapse between when the national survey was done and this survey. So thank you so much for updating us on the temperature of the market out there. And we also asked, it's always interesting to note how outlooks have changed. So we asked respondents about their current thinking compared to their thinking before the pandemic about 2021. So having made their plans early in 20 for where they were going for 21. So the majority at that point although just barely majority had lower expectations, and there was no surprise there. 1/3 hadn't changed. Maybe that was a little surprising throughout the pandemic. And 12% at that point were more optimistic. So, and so who are those 12%? Then those is a bit overweighted. It was a bit overweighted in home builders, residential land developers, which will reflect some of the trends we'll discuss. And also in that 12%, some overweight in investment managers and advisors, but really all real estate groups were in there finding opportunities. So that takes us to the trends. And there are 10 trends. We put them into 3 categories. The first category are trends accelerated by the pandemic. And I just want to say the acceleration is not the trend. It's just the grouping. It's the extent, it's the longevity, it's the direction of each acceleration that is key. So we're going to touch on these 3, Home Yet, the Great American Move, and Reinventing Cities Post-COVID. And then the second category is more trends accelerated by the pandemic. Now, we don't typically label these categories in such a similar manner, but there are so many that were in fact accelerated by the pandemic. And I'll touch on the first 2 here about retail and logistics, which is from just in time to just in case. And then the third category is trends emanating from or during the pandemic. And we'll touch on the first one, the Great Fiscal Challenge. So starting with, are we home yet? So work from home has been a grand experiment, lasting longer and working better than people thought possible at the beginning. So with current thinking, seems to be coalescing around 2 camps. So exemplified on one hand by this quote, very simple, I just never realized how productive this could be. We've got Zoom, WebEx, Slack. On the other hand, there are people that say people can't rise in an organization in a remote-only setting and not only rise, but create culture and innovation. So here's the 2 opposing views, but are they really opposite? And it just doesn't seem like they are. So we asked the survey respondents about whether or not they agreed to what extent they agreed with the statement about companies choosing that will companies choose to allow employees to work remotely at least part of the time. And you can see the very strong agreement there. And remember, this survey is of CEO and other high-level executives. It's not employees saying they'd love to avoid that average 227 hours of commute each year. But the key phrase is at least part of the time. So it's not an either or. As one institutional investor told us, they even early on, they were realizing that that not either or type of thing, that there's going to be some sort of hybrid mix in terms of fewer days in the office, but not no days in the office. And that takes us to how does this impact office buildings and the office sector? So starting with the question of space per worker, we asked about the extent of agreement about whether or not there will be more space per worker post-COVID, although really it probably won't be about social distancing, it will probably be about prudent distancing. So the majority here also seem to still agree on this one as well, but there's still some uncertainty and people who haven't, either they disagree or they're not sure yet, neither agree nor disagree. So not as clear. So certainly there was pre-COVID already pushback on the decline in square feet per employee, and that crammed in factor that many of us were feeling, that was likely going to reverse at least a little bit. Still, it was cost saving measure, and now we have work from home that may serve as both a cost saving measure and an employee benefit. So we're starting to understand that the decision on the part of each company is a series of decision points. So what does it mean to have everyone in the office at the same time, but fewer days? Can culture building or culture maintaining happen if different groups are in the office at different times? And of course, how much space and in what configuration do you need in all these variations? And then of course, if there were a tilt toward the full work from home by enough companies, how would any overall rent decline impact all these interconnected decisions? So these are very individual series of decisions and experiences, and they're the reason that we don't know yet what the end result will be as it plays out over time as long-term leases come due, but it is the reason now that experts' estimates on the impact on the office sector range from minimal, that's where work from home is offset by the need for more space per employee, to an overall reduction in demand of 10 to 15%, which of course would differ by market and by region. So just to note here that, that the benefit of work from home is unequally distributed. Something at ULI that we pay attention to. So if you just concentrate here, just looking at the dark green, this is actually from Brookings looking at census data pre-COVID. And you can see the dramatic difference between the different income levels as to whether or not there was even that possibility of working from home. And this shows the further impact by income. So during the pandemic, you can see that people who stayed at home and unable to work again is very unequally distributed by income level. Again, this is from Brookings. So it's also important to note that as companies weigh the work from home versus in-office balance, that there are some other factors too that besides the individual type of job and individual type of company, Pew Research has found that lower income workers are more likely to have a connectivity challenge. Younger and lower income workers may not have adequate space in their home. And then of course, on the other side, parents who work may find that the office is a more controlled setting, at least some of the time. So there seems to be consensus of the factors to watch and how this may play out for the office sector. And as mentioned before, these factors are still evolving. But there is almost universal agreement. There's definitely a new equation to be solved. Takes us to the next trend, the Great American Move. The people have been moving in all sorts of ways in this pandemic to different geographies, from cities to suburbs, from apartment to a home, and for some back to living with family members. So the move in the Great American Move was occurring prior to the pandemic, but there is no better evidence of the impact of the pandemic on this move than the booming single family housing market, especially in the more attainably priced areas of the US. That's why single family developers showed up strongly in that 12% of respondents. So very early on, they got the wake up notice that this was a positive time for their industry. So an example, kind of going back to a little bit back to the summer, but because the summer is a good example, in Florida in August of 20, there was a 94% year-over-year increase in net single family sales. And August there is typically a slow month. So here's some background on what's fueling the suburban shift, and also the move to warmer and better priced markets. So this chart shows the growth in the number of people in each age category. This is a projection of the next decade, so the current decade that we're in. So from 2020 to 2030. So let's look at the blue first. The two boxes with all blue. So the family formation years, so we're going to see higher number of more people than have been in that particular age segment than we've had for a while. So there'll be increase in that over what we see in 2020. And so those people are the ones that are more likely to be interested in suburban homes and affordable homes. And then the retirees, that there will be a large increase in those numbers of people in those age categories. And those people also tend to be not just suburban, but also moving to warmer climates and lower priced areas. So then looking at the red, so the young adults, you see that decline in the number of people in their second half of their 20s, that's the tail end of because of the tail end of the millennials are moving into their 30s. And those have been the segment of that age, those people in their 20s have been the segment that have been interested in urban living. There'll be fewer of those. And then the empty nesters have also fueled some of that move to the city, and there'll be fewer empty nesters. So another possible way to look at this is that the blue bars are sort of more indicative of suburban living and an increase in the number who will tend to go there. And the red lines are more indicative of urban living and somewhat lower growth in than what we were used to seeing the last 10 years. So I always want to point out that we're talking about slower growth in cities, not cities emptying out. And here's looking at the geographic shift. It's based on U-Haul data from October. So the green are the in-migration cities and red, the out-migration cities. So you can see that, so the warmer, the lower cost, and the smaller markets were experiencing immigration. So you can say that these trends were already in place and driven by demographics, but the pandemic has certainly lit a fire under them. So again, why the work from home? Can you work anywhere? The loss of jobs, need to move to leave the higher cost markets, the need for bigger space. So if you're going to move to a suburb, why not a suburb in an even lower cost or warmer climate? And then, of course, the low interest rates have certainly helped everybody get a lot of house in those lower cost markets. So that brings us to the next trend, reinventing cities post-COVID. So the previous trends touched on the seeds of slower urban growth over the next decade, compared to the explosive growth of the last decade. So we just experienced something that was highly unusual for the previous many decades. This is playing out in both the Sun Belt and the Snow Belt. So this is actually chart actually illustrates a few things. The Sun Belt, the top two lines, has faster annual growth rates than the Snow Belt, which is the lower two lines. This is the last decade. But in both cases, the suburban growth rate is higher than the city growth rate, and since about 2013. So the city growth rates, which are the bottom of each pair, have shown market decline or a slowdown. So it's this ongoing shift to the suburbs that is further exacerbated by the new work from home paradigm, even if it's part-time, even if the work from home is part-time. At the same time, with this tilt towards suburban markets over the next decade, central cities are not going to be standing by idly. So certain cities and some suburbs have they did adapt to pandemic restrictions with creative solutions such as street dining and designating more public space for non-vehicular use. And for decades now, ULI has recognized the value of urban parks and open space. So building on this, further innovation by cities is most likely and is also necessary to provide these types of amenities that have often been more widely available in suburbs. So one urban designer notes that we have a great opportunity. So all this infrastructure that needs to be upgraded and expanded and repaired from the 50s and 60s is going to be, if it can be completely reimagined as a way to bring in more public open space and more public uses. So the trend of suburban locations offering urban amenities is familiar, and that's something that we have emphasized in emerging trends over the last 5 or 6 years, the urbanization of suburbs. What we're looking at now is the trend of the center city increasing suburban benefits, while still continuing to capitalize, of course, on its role of the center for government and for finance and for culture. And this brings us to retail's great transition period. So this is about the retail sector right-sizing and reinventing. So many issues that the retail sector is now facing are not new. Those obsolete or ill-conceived structures, tired retail brands, weak consumer demand due to anemic income growth. Even during the expansion years, that was still the case. Spending patterns shifting away from products and services sold in stores. But now the pandemic and its economic fallout have magnified the pace and magnitude of these existing issues. So this slide shows dramatically what's behind so many department store malls and their troubles. So if you look at the top one, this is revenue growth over almost about 10 years, and sales. I'm sorry, sales growth over about 10 years, and you can see our foodie instincts at the top have been driving restaurants and bars to great heights. And in fact, I think sales in that segment have exceeded grocery store sales for the first time a couple of years ago. But you can see in the opposite at the bottom that department stores just simply have not maintained the sales there. So the public is just losing its appetite for the traditional department store. And and the mall tenants, which really are need that major anchor of department stores, are moved in with that expectation, have showed the least in terms of revenue growth. So e-commerce share of retail sales, certainly, as we all know, dramatically moved upwards during the pandemic. And much of that shift is expected to revert back to physical retailers, in large part because of restaurants and entertainment, but not all. There's not no one expects it to completely revert. So still, I just want to point out that despite that spike, and that we are still spending more in brick and mortar. That's more, over 80%. So that spike is dramatic, but we're still under 20% online. Our interviewees believe that the vast majority of stores and shopping centers will not only survive but thrive, but that's after some painful times and tough adjustments. So painful times and tough adjustments. What does that mean? Many existing retailers will not have survived the pandemic restrictions and the loss of customers. Outside of malls and power centers, the retail sector is actually dominated by mom and pop stores, and they're not capitalized to overcome that sustained interruption in revenue that they've experienced. And some but not enough have been able to tap government programs. So a great number of the temporary closures will become permanent. And although the exact failure rate won't be known for a while, it's estimated that it could exceed 20%. So with that and the major chain closures and bankruptcies that make headlines, there may be another 1 billion square feet coming back to landlords. And that's on top of the several 100 million square feet already empty. This would force rent resets and raise vacancies pretty much everywhere. But the pain will not be spread evenly. So first, with lower rents, the top brands will upgrade their locations. So premier malls will leverage empty space to improve their tenant rosters and survive and thrive. Secondly, underperforming centers will need to adapt, converting some space to complementary uses to create more dynamic centers. And that's something we've been seeing for at least 10 years, maybe probably 15 years now, where there's a wonderful surface parking lot to do some infill with apartments or other retail related activities. And third, the most obsolete centers will finally need to retire their dreams of recovery and instead find an entirely new life for the site. So for many dead malls, that conversion to a distribution center to service remaining physical and online retailers could be considered, but that additional truck traffic will not always be attractive to the community. And is not considered really a universal cure from the perspective of the logistics companies. Still, altogether, all of these things together, so the old adage that change brings opportunity is certainly in play here. And then from just in time to just in case. So in recent years, logistics, real estate, experienced a huge growth in demand and outperformed on a return basis, outperformed any other sector. And this has been due to multiple structural drivers, which we're all familiar with. And it has also emphasized the role of supply chains as competitive advantage. So here's frequent back orders online and empty shelves in stores, highlighted the Achilles heel of just-in-time strategies. So now risk management is also key to supply chain strategies with an emphasis on preparedness. So those are now the just-in-case strategies. And these just-in-case strategies seem poised to accelerate beyond the pandemic as well. And as they have for a while, Emerging Trends survey respondents rated industrial the highest among all sectors for development and investment prospects up ahead. That was, I would say, more for 2021. So the last trend that I'll talk about is the great fiscal challenge. So COVID-19 has greatly reduced state and local government tax revenues while adding new costs related to health and safety. And according to the National League of Cities, the pandemic is on pace to hit cities' finances as hard or harder as the Great Recession. So they have estimated that this current fiscal year, the revenues will be 13% lower than they were in the last fiscal year. So all this shows that all government services will be hurt, but it could be particularly impactful on infrastructure investments, a critical need that we have been highlighting for many years. In mid-pandemic, this showed that 65% were considering delaying or canceling infrastructure projects due to COVID-19. So the real estate community is watching this with a bit of trepidation. And it really has a lot to do with, this is one lender making this comment. The concern is ultimately the higher tax rates and the loss of the unfunded pensions and generally the loss of population. So though not a panacea for all programs and services, this is certainly a time that calls out for the most innovative public and private partnerships for infrastructure. Now, all that I just said was certainly nothing had changed and was entirely in place up until the beginning of this month. So does it still apply? So we had this great piece of legislation that was passed on March 11th, the American Rescue Plan, that had some very important key points for cities. There are 19,000 municipal governments. In the previous fiscal packages, only 36 of those met the population criteria. I think it was 500,000 and above. So only 36 of those 19,000 municipal governments had any support. They will now all be eligible. They will be entitled to federal grants. They can use those grants not to fund underfunded pensions, but for revenue replacement, water, sewer, broadband infrastructure, small business support, and support for impacted industries like hospitality. There's also actually a restaurant revitalization fund in there that is supposed there to support revenue loss. But a key caveat to remember, this is certainly welcome news, but it is already the analysis shows that the cities will not receive a grant amount that is completely equal to their needs. So there will be outstanding needs, and it is a 2-year funding. This is not ongoing support. So it will avert some of the pain, but ultimately it is a time for cities to find ways to get back on their feet. And of course, supplementing that could possibly be an infrastructure program package that's now under discussion in Congress, and that would certainly support that notion of creative replacement and expansion and repair of infrastructure to include more public spaces, as well as to maintain and improve what we already have and expand the notion of what infrastructure can do for cities. So I think I have a few more minutes. Those are the trends that I want to talk about. And I want to talk about one more thing that is not a trend, but we do look into. And that is something that we've been addressing. So we wanted to move a little bit away from this notion of all markets are either primary, secondary, or tertiary, and address the fact that there are investment and development opportunities everywhere for all different types and sizes of appetites. And we always saw that when we went around the country to give our Emerging Trends presentation in person in those days, and even in the smaller markets, it was clear that there was something happening, and usually very cool things happening. So we decided to start really taking a stab at showing some respect for every market, for what it has to offer. And this is something we started last year, last report. This is our current report. We look at 80 different markets, and I'm not going to give you, this is not a memory test or a visual test. I just want to show you that there's something you can look at in the report, but this is the extent to which we create large major groups and then subgroups, and we list them. There are 80 metro markets in there. But I did want to just touch on one of them, one subgroup, the 18-hour city. It is the only one that we actually had come up with several years ago prior to this whole reorganization. And these are cities that are mid-size. We noticed, because we asked our survey respondents to rate the investment and development prospects of these 80 markets, of the markets that they know, so not a beauty contest, for the following year, those prospects of the following year, we noticed that these some smaller markets were moving up in the ranking. So we take the ratings, we put them in order, and those become rankings. So we noticed some smaller markets were moving up over a certain number of years into the top 10 and displacing the 24-hour cities as they became more expensive. And these are, they're not 24-hour cities, they're smaller markets. So that's how we came up with the 18-hour city. And the hallmark of them are the smaller size, medium size, smaller size, lower cost of living, lower cost of doing business. And every one of them is making some concerted effort to create a walkable downtown. Not as extensive and as dense as the 24-hour cities, but there is a there, and that is creating excitement as one more factor in creating excitement and drawing population growth and business growth. And the bolded cities, so there's 10 of these in this category, and the bolded ones there are 5 that are bolded. They are in our top 10 rated cities this year. So the 18-hour cities are still well represented in the ratings for investment and development prospects. So that is my presentation for today. I am going to take myself off, and I think we have of sharing. I'm sorry, I'm going to stay here. And I think we have time for question and answers if people are interested.
I believe we do. We have about 8 or 10 minutes if we stay on course, and that was fantastic, Anita. Thank you so much for that very conversation. So at this point, you can unmute yourself and ask Anita any questions that you may have at this point. No one with any questions today?
I know it was to throw at you.
Yeah. Anita, this is Rick Freeling in Little Rock, Arkansas.
Hi.
I'm just trying to see, what do you see? Do y'all have any trends or anything that says, here's what the future office is going to actually look like? I got what you're talking about, what people are going to do, but what's that office going to look like when people go in and work? What is the trends that y'all are seeing, anything happening to those?
You're talking about the configuration, the inside?
Yeah.
Yeah.
What's the inside of that office going to look like?
Yeah. So I'll have to say, on one hand, I can tell you what people are talking about. But again, because it's such an individual decision, there hasn't been anybody that stepped forward and say, we are definitely doing this. I have to take us, for example, we're not back in the office. If I go to my office now, it will look exactly the same, but I know that's not how it's going to look when we all come back. I think we were an open office. We were at our benches. We were shoulder to shoulder. So so what we hear now is the mix of there won't be as many people in the office at the same time. That the office will become, then the other point that we hear is that the office will become a place that people go to collaborate. So you can do your work at home. You don't need to come to work to shut your door if you ever had a door. So I didn't. But so there's notion of how do you create all that collaboration space for people to do it. And what does that mean? So I'm even hearing people say, well, what could that mean? How much collaboration space do you need? How long does it take to collaborate? I think given everybody's different roles, collaboration requires different amount of time and different kinds of space. So I'm going to throw that into the bucket. I'm sorry, I am kind of not answering the question, but I am answering it in the only way that anybody can answer it right now, which is these are the things that people are grappling with. And that's kind of feeds into why no one really knows the fallout or the impact on the office sector overall. It's all there. Everybody's together figuring it out. Sorry.
Hey, Rick, this is Scott. I'll share a comment talking about how things are changing from a conversation I had this morning with a national apartment developer, not office, but on the apartment side. They said they are basically retooling their floor plans, not to increase the size of the apartments, but to try to shave out some of the, like instead of having maybe washer and dryer side by side, they're stacking them, which is more expensive, maybe reducing the size of a closet or whatever in order to create a space that is like a landing area, work area. Not huge, but maybe 4 feet. But again, this is a national developer, so we are moving in that direction because we think work from home may not be 100% of the time, but people will want that. That'll be an amenity they're looking at. So that was a conversation I had this morning I thought was interesting.
If I might chime in briefly here. So I've been looking at office space for 30 plus years, been involved from the tenant rep side here in San Francisco, and we've certainly seen a dramatic fall off to people showing up in the offices. At the same time, over the last 30 years, all of us seen the architectural development and what an office is supposed to look like. And I have a hard time believing that whatever offices looked like in February 2020 are now suddenly becoming obsolete. Frankly, I'm a contrarian and I've been wrong before, but I believe that once the vaccination has set in, people forget. People generally forget. We had earthquakes here where entire neighborhoods were affected. People thought nobody would ever buy a house there again. 5 years later, home prices are back to where they used to be. And I think there's a distinction when people say that working from home works. Is it functional or does it work? Clearly it's functional. I think we all experience that. Does it work? I think that's going to be the big question that's going to shake out in the next couple of years. Frankly, if I was a person that left San Francisco, moved to Denver to cheaper housing, and I expect my employer to keep on sending the paycheck, the same amount in the next couple of years, I'm daydreaming. This is part of an outsourcing process that I think some big companies enjoy. But if you can do your work from a remote place and never show up in the office, some guy somewhere else can do it for 20 cents on the dollar. And I think that's going to be some of the transition that we'll see. So what I've seen from many companies here is they're holding off. Everybody's holding off. They want to see exactly what happens with the pandemic first before they start making long-term changes to their office environment. Now, at the same time, I would say the WeWork model is kind of dead because density is going to take a good amount of time to return. And that's simply the confidence level. Even if COVID entirely disappears, people are still going to have a little bit of a confidence issue being packed on 4-foot desks right next to each other. So it'll be an interesting development, but I think when people say work from home works, I think there is a little distinction. Does it function or does it work?
So
Yeah, see, somebody forgot to tell WeWorks about that because they're about to issue their IPO and they've got very, very aggressive forecast numbers.
yeah. So I enjoy hearing the contrarian view because that's everybody is grappling with short-term, long-term, medium-term, vaccine, post-vaccine, need for, all the things you mentioned. Don't disagree that those are all equally valid, of course. One thing on the functional, so I think one thing that's becoming clear is that it depends on the nature of the job, the nature of the company as well. So that's very, and that's another reason why we're not seeing wholesale trends immediately as people kind of sort out what do they have and what do they need. But I've also seen there are segments for whom it has been more productive as much as there may be segments for whom it didn't work at all. I think younger workers generally have been chomping at the bit to get back because that's part of their social world and their attachment to the working world is not as deep and as long as older workers who can visualize many years of being in the office and just get down to work. So there's, many things to watch.
Anita, this is Symbiotic in Atlanta. I've actually had people tell me, to follow up on your point, is that they thought they might give up 30 or 40% of their space until they started having their younger people start to quit. So they get to go work elsewhere. They'd be in an office and they got collaboration and mentoring.
Yep. It's interesting. The whole thing is interesting.
We're coming up a minute after. We can certainly ask another few questions if anybody has any.
Paul wanted to be an 18-hour city in Kansas City, but after you lost that Super Bowl, I don't think so.
You mean after the one we won, unlike Atlanta?
Touche.
Yeah. Atlanta doesn't have much to say about that. Anyway, we can talk sports all day, guys. Thank you, everyone, and thank you specifically, Anita. Great presentation, great knowledge, great information. Hopefully, everyone has gotten a takeaway from today's session. This will conclude our spring 2021 conference, virtual conference. Ending it on a great note here with Anita as we progress forward. Thank you, HQ, for all the hard work in putting this together. You guys did a fabulous job once again, as always. We're starting to expect too much greatness from you guys. You're gonna have to keep up in your game. This was fantastic. So thank you very much. And thank you, everyone. I will say I miss you all dearly. I can't wait to see you in person soon. Unfortunately, Ireland is now postponed once again, but as of today, Detroit is still on. So we're looking forward to hopefully being in Detroit in September.
Hey, Joe, thank you for all you've done.
I wish I could do more, but here I am in Wilmington, Delaware for now. So again, I hope to see you guys, everyone, soon. I miss you all. Jonathan, any housekeeping?
No, just thanks, everybody. All these sessions over the last 2 weeks have been recorded, so they are available if you want to pass them on to folks in your office. Stay tuned. Our goal on staff is to do at least one Zoom program a month going forward. I've got a conversation on Friday with somebody who I think is going to do a presentation for us, who's done one before. We've got a LinkedIn program in early May, and then we're just thinking through from there. So just like Joe said, hope to see all you guys soon, face to face.
Thanks again, all. Have a great rest of your week.